All righty, everybody. Thank you for coming in. Our next presenter is Smart Sand. Lee Beckelman with Smart Sand. Smart Sand is a fully integrated sand supply and service company offering complete sand, logistics, storage, management solutions to their customers with in-basin transloading terminals and their Smart Sand storage capabilities. They own and operate premium sand mines and related processing facilities in Wisconsin and Illinois. Please help me welcome Lee.
Thank you. Thanks for being here today. I'm Lee Beckelman. I'm our CFO. I've been with Smart Sand since 2014, and I've been in the energy business either as a banker or CFO of other companies for over 30 years. Today we're going to talk about Smart Sand. We are a provider of northern white sand mine to well site solutions. Today we have 3 high-quality mines that are based in Wisconsin, Illinois, and we really think we have the right operating model because we have 3 assets today that have a combined 10 million tons of annual processing capacity, over 500 million tons of high-quality northern white sand, and have access to all Class 1 railroads in the United States. We have direct access to 4 railroads, being the CP and UP, the CN and the BN, and then we have good connections to the ENS and the CSX. We also have a very low operating cost structure. Basically, we're a bulk commodity business, so we build it on scale, so all of our operations are very highly efficient in that we mine, process, and ship the sand from the same locations. We also have a very low operating cost model that allows us to be very efficient and compete in all of the markets that we support today. And then we have a long-term sustainable supply advantage in that we connect to the Class 1 railroads from our 3 locations. That gives us access to all operating basins in the U.S. and Canada, and we have our own terminals in the Bakken and in Marcellus that allows us to get very efficient in terms of delivering our sand and logistical footprint into the markets we serve. And then we have what we believe is the right sand. Today, our sand reserve is over 70% fine mesh sand. The market today for frac sand is about 80% fine mesh, so our reserves match up very well with the market demand overall. And then we have a very strong capital structure and commitment for management. We're very lowly leveraged. Today we have about $13 million of long-term debt with about $5 million on our cash balance sheet, so our net debt level is less than $10 million. Against a run rate EBITDA of the last 12 months, about $40 million. And we've managed our company very carefully and prudently from a balance sheet perspective. And that was one of the reasons we've been able to survive the downturns in this commodity business versus a lot of our peers. And then we have high insider ownership. Chuck Young, our founder, owns 17% of the business. Collectively, insiders, which includes management and founders of the business, own 31%. So we're very aligned with our shareholders and looking for long-term value in the company over time. Again, we're a fully integrated provider of mine to well site solution. We'll talk about more of these points later in the presentation. But the reality is we mine on a very large scale basis, all 3 of our facilities, and process the sand there, and then we're able to ship on very large transloads that we ship on a unit train basis to all of our operating basins. And then from there, we provide last mile service and being able to deliver the sand and provide the sand directly into the blenders for the pressure pumpers and the EMPs. Our summary financials over the last 5 quarters, we've had very consistent performance, selling over 1 million tons per quarter, generating EBITDA of $8 to $11 million range, and showing improving contribution margin. Our contribution margin's grown from the low teens to the mid to high teens over the last 5 quarters. We've also generated positive free cash flow over the last 4 quarters. Year to date, through the first 6 months of this year, we've generated approximately $12 million of positive free cash flow. In terms of the market overall, even though rig count and frac spread activity may be has moderated a little bit over the first 6 months of this year, frac sand demand continues to increase. This has really been driven by frac designs as E&Ps continue to have longer laterals, have more stages per lateral, and use more sand per stage. So this is a graphic from Spears & Associates that shows the use of the average amount of frac sand per frac spread. And you can see over the last 6 years that amount of sand is basically more than doubled per spread in terms of sand uses per spread. We expect this trend to continue as E&Ps continue to increase their laterals and continue to increase the use of sand per well. Overall, proppant demand in the U.S. has been increasing pretty strongly over the last few years. This graph shows that we hit kind of a low of 64 million tons in 2020. That was during the pandemic. You can see over the last 2 years, we basically more than doubled the amount of demand for frac sand in the market to about over 120 million tons. And right now, Spears projects about a 5 to 10% growth this year. And in the current pricing environment for oil and gas and kind of activity in North America, we kind of believe that that'll be a continued steady 5 to 10% growth in frac sand demand going forward. This graph here kind of shows you the market fundamentals for frac sand in the U.S. and in Canada. The blue bars represent the demand per operating basin versus the orange bar represents the supply source, the regional supply available to meet that demand in that market. And you can see that the primary markets for Northern White sand today are the eastern markets of the Appalachian Basin of Marcellus and Utica, the Bakken in North Dakota, the Rockies in Colorado and Wyoming, and the Canadian market. Today, through our 3 facilities, we have very sufficient and sustainable access to all 3 of those 4 primary markets. We serve the Bakken and the Marcellus through our Oakdale facility. We're able to serve Canada through our Blair facility that we opened up this year, and we serve the Colorado and Wyoming primarily through our Utica facility in Illinois. That matters because we need to be on different railroads because different railroads support different operating basins. But you can also see that there's been a recent activity that there's actually been an increasing demand in the Texas and Oklahoma markets is starting to lead that demand there is potentially exceeding supply of regional sand in those markets. So we're also seeing some potential opportunities to reinstitute Northern White sand and sell Northern White sands in the Texas and Oklahoma markets. So overall, the fundamentals for demand for Northern White continue to be good. This is an analysis that was done by Rystad Energy that shows kind of our share of the market in terms of available capacity. With our acquisition of the Blair facility in 2022, we now have 10 million tons of annual capacity and believe we're the number 2 provider in terms of capacity available to serve the Northern White market. And we're a strong believer in Northern White. We're a pure Northern White play today. For those that are not that familiar with the proppant market, there's 2 main sources of frac sand in the market today. There's Northern White providers that mine and produce that sand in Wisconsin, Illinois, and parts of Missouri that gets railed to the basins. And then there's what's called regional sand, that's sand directly in the operating basins. We believe Northern White is a much higher, superior quality product, and that leads to better long-term well results. We actually supported a study by Rystad Energy that was basically commissioned by the Wisconsin Industrial Sand Association that looked at well results in the Permian Basin from 2018 to 2023, looked at 7 different operators and analyzed over 900 wells, comparing wells that were drilled and completed with Northern White versus wells that drilled and completed with regional sand. And the results on that were pretty compelling. You can see that 6 of 7 operators showed much better results, or actually deteriorating results on regional sand versus Northern White. And over a variety of different price cases, if you would have used Northern White versus regional sand per this study, you would have had a better overall financial return over the first 3 years of production of those wells. We've also commissioned a white paper. It's on our investor site today, that we actually did additional studies on this that adds an incremental value and shows incremental support for the fact if you use Northern White, even though it'll cost you more up front to drill or complete a well in the Permian, for example, not because of the cost of the production of the sand, but because of the logistics cost to deliver the sand by rail versus by truck in the region, you can still achieve much better long-term results from that well by having better production performance over time by using the Northern White. Highlights of our mining production today. We have 3 main facilities. Our main facility is the Oakdale facility that we opened in 2011, originally 1.1 million tons of capacity. Today, Oakdale is at 5.5 million tons of capacity, has over 250 million tons of reserves, has direct access to the CP and the UP, and it can basically deliver sand into any basin in the country. We acquired the Utica facility from Eagle Materials in 2020. It was idle, and they were looking to divest from the Northern White sand business. We were able to acquire that facility for $2.5 million in stock, We invested about $2 million to bring it back online and started operating it at the end of 2020 and operated it through 2021, and it's operating today. That facility is connected to the Burlington Northern, which gives us very good access primarily into Colorado and Wyoming. And the other reason we invested in Utica is that it's well positioned in the Chicago metropolitan market, and we are diversifying in industrial sand, and that facility is well positioned to compete for industrial sand on a go-forward basis. And then finally last year we acquired the Blair facility that was idle from High Crush. That was a facility that's a 2.9 million ton facility, has over 120 million tons of reserves. It's a very similar structure and build out as our Oakdale facility, where we have a large mining operation coupled with the processing and over 7 miles of rail track connected directly to the CN. That now gives us entry into the Canadian market. Before having access to the Canadian national rail line, we weren't able to compete effectively into Canada, and now we are, and that gives us a new market to grow into selling our Northern White product. We have a very low cost structure because we built the business as this is a bulk commodity business where scale matters, and being able to have very efficient operations can lead to low cost of production over time. So we mine, process, and have very large transload facilities at our plants to allow us to be very efficient in terms of having a very low cost and be a low cost producer in the business. We also have very low royalty rates. Royalty rates we pay at Oakdale facility are about 50 cents a ton today. At Utica, we actually have zero, have no royalty that we have to pay there. And at Blair, our royalties are less than $2 a ton. So we have a very efficient operation, and as we get our utilizations up to 60 and 70%, we can really spread our fixed costs and really drive down our production cost. This is an overhead picture of our Oakdale facility. This shows you that Oakdale has 5 dryers, 5.5 million tons of capacity, and 2 wet plants, as well as over 11 miles of rail track to support our logistics operations. At Utica, our Utica facility has 1.6 million tons of capacity. It's 1 dryer and 1 wet plant. Utica, the wet plant's fully enclosed, so it's a full year operation in terms of manning our wet plant. At our Oakdale facility, 1 wet plant on the west side is enclosed, so we're able to mine and run that wet plant consistently year-round. On the east side, our wet plant is outdoors, so this is Wisconsin, so in the winter months we don't run the wet plant, so we build up our wet inventory over the summer months and then use that inventory in the winter months to meet our full year demand. And Blair is a very similar structure as to Oakdale. It's a 2.9 million ton capacity facility, has 2 dryers, 1 wet plant. Again, the wet plant's outdoors, so we run the wet plant between April and November, build up our winter inventory, and then we utilize that inventory during the winter months to support our full year operations. In terms of logistics, again, our business logistics matters. All of our sand has to be railed to the operating basins. So again, today, we believe by being connected to the 4 main Class I railroads, that gives us access to all operating basins today, but also allows us to force the railroads to compete to try to drive in our cost. And then we built our model similar to how you try to move coal, and then we try to move all our sand on a unit train basis. So we ship our sand in 100 to 150 car shipments, filling up those cars at Oakdale, and then having that go directly to the transload in the operating basin, where it's then unloaded, and then we can hook and haul and deliver that 100, 150 cars back. That allows us, versus kind of manifest movement, to move our sand at roughly 1/3 of the time as it would if we were doing it on a manifest basis, and also gets a better utilization of our rail car fleet. Have about 3,500 cars of rail cars directly that we can control, and we're able to turn that rail car 2 to 3 times in a month by shipping on a unit train basis versus 1 to 2 times if it was on a manifest basis. We have 2 terminals. Terminals are key drivers of our business. We invested in a terminal in Van Hook, North Dakota in 2018. It currently has a capacity of up to 3 million tons. That allows us now to be able to control that movement from our plant directly to our own controlled terminal, and really allows us to get efficiency of movement, negotiate really better rail rates. When we opened the Van Hook terminal in 2009, to give you an example, in 2017 about 5% of our volumes went into the Bakken. Since we've opened that terminal, we've been able to grow and sell our volumes to today, where the Bakken represents, depending on the month, 30 to 40% of our volumes on an annual basis. So having your own terminal and being able to control that access or having good access to terminals is a key driver for us to being able to penetrate the key markets that we serve. We also invested in a terminal in Waynesburg, Pennsylvania. It's in southwestern PA, right in the heart of a lot of the key drilling activity there. And we invested that in 2022. It has about 1 million tons of capacity today. We're currently invested in expanding it. We have it permitted that we could ultimately grow that to 3 million tons a year. And the same driver to invest in Waynesburg as we had in Van Hook, North Dakota. By being able to have our own terminal, we're able to control that movement, to be able to negotiate much better rail rates and be able to provide our sand at higher volumes more sustainably and sufficiently for our customers, and has allowed us to grow our market share there as well. Probably about 10 to 20% of our sand went into the Marcellus before opening this terminal, and today, again, depending on the month, 30 to 40% of our volumes now go into the Marcellus. This is an example of basically sand by rail versus in-basin delivery by truck. Basically, all our sand comes into a rail to a terminal. That terminal is usually around 50 miles to the well sites versus on a truck and in-basin. Normally, you might truck anywhere from 100 and 150 miles. By being able to bring the sand in a bulk commodity basis in 100 and 150 rail cars and then transport that sand by truck on a much shorter route, you're able to dramatically reduce the number of trucks that are used to deliver that sand to the well site. So from an ESG perspective, for our customers, by using sand and delivering it by rail and having it in closer proximity with that terminal, you can reduce the truck loads to the well site by over 50%. That reduces diesel, reduces potential accidents, and provides a more efficient movement of the sand. Another piece of our business is our last mile service business. Today it represents 3 to 5% of our revenues. These are basically storage fleets that we use and we rent to our customers at the well site to basically take the sand that's delivered by truck to the well site and deliver that sand into the pressure pumping equipment. We have a proprietary transloader that can actually take sand from gravity dump trailers with a belt technology, deliver that sand directly into the pressure pumping equipment in the blender, and really allows a very high volume usage of sand at the well site that compares very favorably to the Solaris silo units. We do have silos that provides buffer storage, so we compete directly with Solaris and the silo units, as well as the sandboxes of US Silica and Liberty and other providers at the well site. We're still relatively small footprint. Today we have 6 fleets in Oklahoma that are silo-only fleets, so they don't use the transloader. And then we have today 9 total, what we call smart path fleets, would be a transloader, 4 silos, and then we're adding the smart belt technology to really help us really reduce our maintenance costs, increase our margins, but also deliver more sand into the blender from a competitive basis. All 6 of our silo fleets are rented. About 3 of our smart path fleets are rented today. We're adding 6 more belts this year, so by the end of the year, all of our smart paths will have smart belts, and we hope to be able to dramatically increase the utilization of our smart path fleets in 2024. One of the key drivers relative to our competition, we have a much smaller footprint. We basically have 4 silos, a smart path where the trucks can drive on, unload the sand efficiently and drive off. So we have a much smaller footprint than the Solaris model and or sandboxes, where you have to have multiple boxes stacked up to feed into the blender. And then with our new smart belt technology, we believe we can deliver a lot more volume and higher volume of sand into the blender at a much better, more efficient rate than our competition. That's become increasingly important as E&Ps continue to go to simul-fracs and using more sand per well and wanting to be much more efficient at the well site. So being able to handle that sand more efficiently will be a good driver for this part of our business going forward. Then a final piece of business is an area that we basically started investing in 2022. This is really driven by our Utica facility primarily because it's well positioned in the Chicago metropolitan market to basically compete and grow in the industrial sand business. Industrial sand business is more regionalized. A lot of it's trucked, a lot of it's smaller volumes. It's also can be packaged in bags, and so typically the sand sources are much closer to the end users than in the frac sand business. And so Utica is well positioned to compete for that. We have actually making about a $4 million investment this year at Utica to add cooling and blending capabilities. That's allowing us to be more proactive in going after a broader set of that industrial sand market. And we hope to grow this part of our business. It'll never be a majority of our business, but we hope to grow this business to be 5 to 10% of our sales on a go-forward basis. In the second quarter, about 5% of our sales volumes were in the industrial sand business. So that gets to kind of summary of Smart Sand. Again, we believe we have a very sustainable operating model. 3 high-quality mines, 10 million tons of annual processing capacity, a very strong logistics network connecting to 4 Class 1 railroads directly, along with good connections to 2 others. A very prudent capital structure where we manage our business on a low leverage basis, generating positive free cash flow on a sustainable basis. And we've got a very strong commitment from the management of the company in terms of investment and being aligned with our shareholders to focus on really long-term value growth and creation for the business. And with that, that's the end of my prepared comments, and be happy to open up for some questions. You bet.
I have a question on Northern White versus regional. You referenced the Rystad study.
Yes, sir.
I guess just appreciate the results, but just like I guess physically, like what's going on, what makes it better?
Well, there's 4 primary areas that you look for quality of sand. The main one is crush strength. So Northern White, today the sand is mainly fine mesh. There's 4 products of frac sand. There's 20/40, 30/50, 40/70, and what's called hunter mesh, which is 61/40. That's basically after you mine the sand, you wash it, you go through dry plants, and then you screen the product by molecule size. So the smaller the number, the bigger the molecule. So 20/40 gets scalped off first. Then you go to 30/50, 40/70, and hunter mesh. Today, 80 to 90% of the market is fine mesh sand. 40/70 hunter mesh, and the key driver and one of the key components of frac sand is the crush strength, because you're using that sand when you frac an oil and gas well, you blast that rock with water, chemicals, and sand, open up the fractures, and the proppant holds it open. Now you're 10,000 feet below the ground or farther, and so there's very high pressure, so you need that sand to have a high crush strength to maintain that fracture as open as long as possible to allow the oil and gas to escape. So Northern White, this is, you can find this is well known. So it's not something you can't go out and find through public sources. Northern White typically has crush strength anywhere from 10 to 15,000 psi, versus most regional sand is probably in the 6 to 8 to 9,000 range. So that crush strength allows that proppant to stay open longer. Secondly, Northern White is a very spherical, so it's very smooth like a marble, versus a lot of regional is more oblong shaped. And so again, think about if you put marbles in a glass jar and you want fluid to flow through it, being spherical allows more fluid or gas to flow through versus odd shapes. So that sphericity is important as well. And then finally, Northern White is a monocrystalline structure, so it's one single molecule, versus a lot of regionals are poly, so they have 3 or 4 that are crushed together. This is part of the crush strength, so that allows it to have higher crush strength, so it doesn't degrade in the fracture as quickly as a regional, versus regional get into that pressure, it'll break up and it'll clog up those fractures. Does that help? Now that being said, I didn't highlight this, but the reality is our business model is not built on having to win in the Texas and Oklahoma markets. We basically have grown our volumes from roughly less than 2.5 million tons back in 2019 to 4.3 million tons last year, and all of that's really going into the primary Northern White markets. In 2017, 35% of our volumes went into Permian. Today, we've more than replaced and grown that by being able to put our focus in the primary Northern White markets. And we think there's more than enough growth to sustain and grow our business in those markets. But the reality is the Permian represents 40% of the activity in the U.S., so any volumes we can sell in that market is obviously going to be incremental value to us. And we don't need the whole market to shift. We just really need 1 or 2 providers that are really looking at long-term and looking at large volumes and see the value of being able to manage that in a much more sufficient manner through rail. You can actually, you can get on, if they have direct acreage on rail sites, they can build their own terminals. We can deliver it very close to their well sites. And if we can get 1 or 2 customers that want to use large volumes over 2, 3, 4, 5 years, and then the customer and us can go negotiate those rail rates, we can dramatically bring down that cost differential between Northern White and regional. The cost differential is totally related to the logistics, has nothing to do with cost of making the sand. What else? I guess we're done. Any other questions? Well, thank you very much for your time. There will be a breakout session as well.